small cap index is what absolutely unchanged as well. So 18,060 is where the Nifty small cap index is now trading at. So this is a very, very quiet Thursday morning start. Nifty heat map comes up on your screen. It's absolutely evenly balanced. Some 2022 names are higher and the rest are lower to begin this morning. 40 points lower on the Nifty at about 25,000 levels. Surabhi.
I just want to point out before I get to the Nifty stocks, one stock, PB Fintech, it's starting lower once again. Remember, yesterday was down 4% after Yash, put out the story around the possibility or some discussions at least beginning about capping insurance commissions. PB fell 4% yesterday, now 1%, 1.2% lower this morning. So let's keep that on our radar as well. On the large cap screen, 47 to 50, actually 50 points down on the Nifty. Tata Motors, and Suraj explained that very well to us. It's a huge hit. Over 2 billion pounds is what we're talking about here because of that cyber issue, 2% lower on the stock. The other weak names include actually Maruti Suzuki, Hero Moto, Bajaj Auto. So all of auto is cooling off. Profit-taking is the order of the morning at least. Titan, Eternal, these are some of the other names from the consumer side that are weak. Reliance is not helping the bulls case this morning. It's down about 0.4% at this juncture. And there's some selling in insurance names like Bajaj Finance, HDFC Life, SBI Life. So some of these, non-banks are also down. On the upside, however, you've got Hindalco up 1%. Bharti Airtel up 0.7%. And the FMCG plays, Nestle and Lever are having a decent session today. Even Tata Consumer, actually. So small gains over there. But all put together, little change. 25 lower on the Nifty now. Nigel.
Well, that's right. You know, the Polycap, there was a large trade out there. That got executed in the pre-open. And in fact, the large trade actually was almost double its size. But yet the stock has recovered from the day's low. It's more or less flattish as we speak. So just keep an eye out on that name. Another one that's doing very, very well is Finiotex Chemicals. I'm looking at the BSE exchange. They are saying that, in fact, they will be considering an interim dividend, share split, bonus on the 27th of September. That's when they have their board meeting. So that stock, in fact, is running away. Finiotex Chemicals, that's the stock. Yes, now up close to around 15%. So massive up move is what we're seeing on that name. Zuari Industries, well, that one this week itself is up close to around 35%. It's not a name we talk about very, very often. But for today's trading session, it's one of the top traded stocks. So that's why it's up close to around 6%. Adani Power saw some profit taking yesterday. Today, it's resumed its winning ways. Hindustan Copper, that's the only pure play on copper price moves. And as Manisha told us, there's a bit of a supply issue. Demand as well has been steadily increasing. So that one continues to build on to gains, up close to around 2% or thereabouts. Newgen, some positive news flow that did come in on that stock. So that's why that one is up and about in today's trading session. What else has come for some profit taking? Edelweiss Financial, well, that's one stock that's falling on rather decent volume. So just pointing that one out. All in all, I think it's a fairly decent start to trade. You have Quality Power. That's another stock actually that's seeing a good amount of up move. Positive news flow came in overnight. That stock is well up close to around 5% as we speak. Prashant.
Okay, no, absolutely. And, 20 points lower is what the Nifty is now trading with. 20-point cut, 10 points. Nothing very much. It's flattish, so to speak. Adani Power is the top volume-led gainer right now on the NSE. So Adani Power had this rocket-like move. And it basically went from 120 to 170, 180 in 3 days. From 180, highs of 183 basically. Yesterday it sold off in 2 sessions to 140. And now at about 150 or so. So huge volumes on Adani Power. Actually, the entire Adani Group stocks had a very large move after that SEBI clean sheet. And then, of course, they all corrected over the last 2 days. So we'll keep an eye on the others as well. Hind Copper, Nigel mentioned, Garden Reach is up 2%, Zuari is up 8%. Zuari has got very heavy volumes. Cochin Shipyard is coming up with about a 1.25% cut. There is what else? Hindalco up 2%, copper prices are higher. KPI Green is another one. Market breadth is closing. The gap was, but this is, of course, very, very early in the session. But 1,200 lower and about 1,000 stocks are higher. At this stage. Tata Investment Corp has been another one of those rockets. So from 7,300 in 2 days flat to about 9,000 bucks. And today it's just pulling back a little bit, not very much, 3.5% odd. It's all relative to, of course, the size of the moves which have been. Very large. Okay, Pankaj Murarka is with us, CEO and CIO at Renaissance Investment Managers. Pankaj, great to have you with us here. Thank you very much for your time. Individual names, Pankaj, I mean, you got to be in them. Otherwise, you just see them shooting up like rockets all around you. And so many of these, right? You just sometimes, and as someone was lamenting, everything that I don't have keeps going up. I think. How are you looking at things, Pankaj? You know, we had a nice up move and a bit of a pullback now. What's the view?
Morning, Prashant. Prashant, I think as far as markets are concerned, meaning our views, while primarily we still remain, the underlying trends still remain bullish. So we are very much in a bull market. But I think we think probably over the next couple of years, the gains from markets will be far more moderate than what we've seen in the last 3-4 years. The fact is that we are in the 6th year of bull market in the most expensive equity market in the world. And more importantly, we are now coming out of 6 quarters of earnings slowdown. The good thing is that probably earnings have troughed, and probably starting this quarter, could be a bit slow again because of that slowdown in sales and retail, which happened in the month of September, for the first 3 weeks of September. But I think markets will be looking forward to the next quarter, the third quarter earnings, where the spillover effect will be visible. So probably the good thing is we'll start seeing earnings acceleration now after 6 quarters of slowdown. Yet I think, while the index, what we've really seen, if you see over the last 4 quarters, is while index have held steady, but the broader market is where there's been a lot of action. And as you were rightly saying, there are a lot of stock-specific action. But I think that's also partly a reflection of the pockets of market where we see a lot of fraud. So I think investors should be very careful in terms of what they're buying into, and probably take a slightly more medium-term view.
Okay. But you are saying that earnings should pick up after several, dull quarters, and that's good to hear. Pankaj, good morning. Surabhi here. So the question really is that, what next? Because while the index has remained flat, individual stocks have done really well. I mean, even the large cap ones, for instance, auto. Now, on the whole consumer piece, do you think this is going to be a durable move that will last? And if yes, and what part of it? I mean, should one be in the auto space? Do you think that QSRs or other formats of discretionary consumption, or maybe even, regular staples, it'll be their time in the coming few months?
Morning, Surabhi. I've been saying this for a while, and now there is even more credible data points to suggest that. I think we are in for a very healthy consumption recovery in the economy over the next 4 to 6 quarters. We're coming out of a very sharp slowdown in consumption over the last 8 quarters. I think what the government has done in terms of the combination of monetary and fiscal stimulus that's been injected into the economy, on an aggregate basis, that adds up to about something like about $50-odd billion across tax cuts, 100 basis points of rate cuts from RBI, and now there's GST cuts. That's close to like 1% of GDP. So I think that's a very meaningful stimulus that's been injected into the economy. Consumption recovery, we've seen from past cycles, when they happen after such a prolonged slowdown, it takes a while. So while there'll be an initial burst or frenzy of the pent-up demand, because some of the discounts and lower prices will tempt marginal buyers. But more importantly, I think we'll see a more sustainable recovery in consumption over the next 4 to 6 quarters. And I certainly think so. One should be invested into consumers. We maintain an overweight stance on consumer stocks after almost a gap of almost 6 years, where I'm finding valuations are more reasonable in consumer stocks across both staples and discretionary. And we are looking for acceleration in earnings growth. And I think so is the case with autos as well, because you look at some of the data points in autos, the two-wheeler sales today are lower than what they were in 2019. Or passenger vehicle sales, especially small car sales today, are the same as they were in 2019. So it's been about 5 or 6 years of anemic volume growth that the sector is coming out of, which effectively means there is a lot of pent-up demand that exists in the system. And now with this stimulus, I think that will act as a very strong driver for growth in this sector. So I think consumption across both staples, discretionary and auto remains one of our preferred bets.
Okay. Hi, Pankaj. Good to see you. I wanted to ask you about the public sector banks. I was reading a Motilal Oswal note. They have pointed out the market cap has jumped nearly 5x in the last 5 years. Yet they're trading at reasonable valuations. The ROEs remain at around 18% odd, ROAs at around 1%. And now they're pointing out that public sector banks, they could outpace private sector growth, loan growth, for the first time in nearly 15 years. What's your view on the PSU banking names? The reason I ask you this is, just in the recent past, we have seen actually some bit of outperformance coming back into play after going through a period of underperformance. So what's your take?
Well, Nigel, PSU banks have come a long way in the last 7 years from where we had seen in 2018. These banks had huge losses because of bad loans and all of that. And government went through one round of consolidation in PSU banks. And from there, obviously, profitability has improved. But I would still say, if you look at on an operating basis, barring SBI, the operating metrics for most of the PSU banks are inferior or somewhat lower than private sector banks. So as far as quality in terms of ROA or our capital efficiencies are concerned, private sector banks are much better than state-owned banks. Obviously, valuations, if you look across the board, in case of state-owned banks, are much cheaper at points, depending on the bank you're looking at, somewhere between 0.6 to 0.9 time price to book. Most of these banks are trading on a 1 year forward basis below book value. So I think there's been some noise around government looking at one more round of consolidation among state-owned banks and government allowing higher voting rights for foreign shareholders and a higher increase in the voting cap of 20%. I think eventually, if the economy is to grow, and given the fact that state-owned banks are still almost like about 60% of loan market share, in the industry, these banks will need capital. Government in the past 6-7 years has given them enough capital, but government will have to, allow these banks to raise more capital in that sense and allow the restrictions, lift the cap on foreign holdings. So in valuations are reasonable, but I still think there's some more work that these banks need to do to improve their operating metrics. So I think there could be a valuation catch-up trade. And if at all the government goes ahead with, whenever we finally see the execution of IDBI divestment, because that's in the works for almost like 6 or 7 years, and probably there's another round of consolidation, I think that can help to improve valuations in state-owned banks.
Yeah, you've been a fan of PSU banks. And remember SBI was a top idea, right, Pankaj?
Yeah, so our preference still, Prashant, is for private sector banks. Within PSU banks, the one we own is State Bank of India, because we essentially like the franchise, because it's a very strong brand, very strong franchise. And in terms of most of operating metrics and capital efficiencies, be it ROA, ROE, or asset quality, State Bank actually is almost at par with most of the leading private sector banks. So despite being a state-owned or government ownership, it's one of the best-in-class banks that exist in India.
Give us one or two ideas, Pankaj. Something looking interesting, away from the large cap, well-discussed names, where you think there is value.
Okay.
With full disclosure, please consult your advisor before investing. But yeah, go on.
Yeah, absolutely. All the disclosures apply. But I think we should not be hunting for value in this market. As I said, in the 6th year of a ferocious bull market, in the most expensive equity market in the world, obviously there's no value on the table. Stocks and markets are priced to perfection. But the good thing in India is, given India's secular and sustainable growth story, you can find a lot of growth stocks where you make money out of future growth, and buying them, I will not say at value, but at a reasonable price. So let me share a couple of ideas which I find interesting at this point of time. I'll give you a context. One, I am very positive on discretionary consumption coming back, as I said, because we're coming out of 8 quarters of very sharp slowdown in consumption. So just think about it. We have about 50 million people who invest in stock markets or trade in stock markets. And the organized pizza industry just has about 10 million customers. So Jubilant Foods is a company that we own in the space. They dominate 70% of the organized pizza market. I think that space can really expand significantly. I would like to believe that everyone who's trading or investing to stock markets can at least afford to have one pizza, a quarter or something like that. And if that be the case, that the TAM for that space can expand very significantly. So that's one we like on the discretionary consumption side. Apart from that, we like this the whole internet space I've been talking about for a while, because I think the growth visibility there sustainability of growth, high growth for a long term looks, very much possible in those sectors. So we like the food delivery sector. We own companies like Swiggy and Paytm there, and I think these companies can sustain, growth which is north of 20% for the next 5-7 years. So even while the starting point of buying is not so attractive, but I think the next growth over the next 4 or 5 years will compensate for all of that, and one can still make healthy returns from these names. As I said, all disclosure applies because we have ownership in all of those names I spoke about.
It's interesting you mentioned the pizza company and you mentioned Swiggy as well. Actually, I don't know if you think about it, before Swiggy and food delivery became such a phenomenon, right? Maybe that was the inflection point for, in a negative way, for Jubilant, right? Because now you could get Chinese, you could get Indian, you could get whatever you want delivered to your doorstep. Before that, it was Jubilant with their, delivery, and if you don't get the pizza in time, you get the pizza free, and used to do very well.
Yeah, that's true. But over the last 4 quarters, if you see Jubilant, they've been making a lot of pivots in their business so as to enhance the TAM. They've introduced, I don't know if you are a consumer, but if you're not, you should try their what they call the square pizza that they've launched, which is a much bigger pizza, and they've added more value to the meals and had multiple other offerings, kind of a thing. So which is really leading to very strong growth that we've seen in the last 3 quarters. And this is happening in an environment where consumption spending has been slow. So when consumption picks up, I think they should be a beneficiary of all the investments that they've made in the business over the last 4 quarters.
And valuations are okay here?
Valuations are rich across the board, Prashant. If you want to buy a high growth, high quality franchise, there is nothing that is available cheap in this market. So one should reconcile to the fact that we'll end up buying some of these stocks probably expensive, but the future growth will compensate for that.
Yeah, okay. Buy pay up for growth. That's been the mantra here. Thanks very much, Pankaj. Really appreciate your time and good chatting with you. And of course, all disclosures, once again, as you said, Swiggy, I think there was Jubilant and there was Paytm in terms of single stocks that we spoke about. Markets are up about 15 points and, the market breadth has swung to the other side. About 1,400 stocks are higher and about 1,150 stocks are lower. At this stage. So lots of stocks into the mix, and I'll sort of cover them in just a bit from now. But I think we have our first management post-market open with us. Surabhi.
Absolutely, and it's management from a very hot sector that's in the news, and I'm talking about IT services. Well, this morning we have the management of Happiest Minds joining in. Venkatraman Narayanan, Managing Director at Happiest Minds Technologies, is with us. Venkat, thank you so much for taking out the time. As you can imagine, we have many questions. I just want to lay out sort of a broad framework for our viewers to outline what we really want to discuss. Obviously, we'll talk about this whole US H-1B visa issue, the impact, not much on this company. They don't send too many workers on these visas to the US as of now, but we'll find out what it really means. And then, of course, we'll discuss demand trends in the second quarter and the rest of the year. And, of course, the outlook on Gen AI. Happiest Minds has a dedicated unit. We'll find out what's happening. So, Venkat, thanks so much for joining in once again. Let's start with the first one, H-1B. Now, our colleague Rima was explaining to us that you folks, a large part of your model is built offshore. You don't send too many people to the US. I think only 3-4 people, I think, on these H-1B visas. So while this is not big for you right now, I'm sure you would have been having a lot of discussions around this because you have your own aspirations of touching $1 billion in revenue over the next couple of years. So is this going to be a big dampener eventually for you and overall for the sector?
So first, to clarify, I think you got the numbers right. We don't send too many people on H1. We've got about 4 people last year and 3 people up until today for this current financial year. So as that shows, we are not very dependent on H1s going from here to US. For our requirements, we do local hiring. And, we had acquired a couple of companies. They have also brought in the talent that we have been looking to, add on site as required. As far as you said about our aspirations, there is going to be both an organic growth, which means we'll continue to do a lot more in the same model or a similar model that we are doing of substantial offshore business. but we'll also be growing in geographies of other than US, because H1B is kind of a small dampener for the industry. As far as US is concerned, but you have to spread yourself across the geographies. The last couple of acquisitions that we did has taken us to countries like Africa, Europe, and even Asia Pacific. So that's one thing which will help us broad base our revenues.
Sure.
On top of that, we'll also grow through acquisitions, on-site companies, companies based out of US. Those will all be the ways we'll tackle the growth objectives, while also, being able to surmount this temporary H1B visa hike for the industry.
Got it. So, Venkatraman, you have your plan in place, but if I could ask a broader question, I'm sure these conversations would have already happened over the last 4-5 days since this news broke. I mean, just to understand at this juncture, the cost of getting that work done on site with a local hire versus sending someone on an H1B visa with this higher 100,000 fee, what is the offset? And do you think companies will still take the hit and still keep sending Indian personnel over there?
See, you'll have to look at the expertise and the economics put together. Until now, expertise was, paramount. Economics was always there because, you were moving people from India to US. But as you go forward, you'll have to look at both of them. And, typically in a large project with, let's say, 100 people offshore, you may need 1 or 2 people on site. So there could be an element of investment that, both sides, the customer and we'll have to make sure that on-site presence, if required, we'll be able to, send that those kind of people who can then be the connect between us and the customers, offshore connect or the on-site connect that we call, could be that person. So obviously, economics and expertise will go hand in hand. And in those cases where we have to make those investments, we'll make those investments, because I think it's an investment in the customer, in our technology offering, in our offerings rather, and in a particular technology. We look at it holistically. So it's not like I don't want to use the word body shopping, but we don't get into that kind of a business on an H1B. It's always been expertise based for us.
Okay, so good to speak with you, and as always, Prashant here, Mr. Narayan. So, one is H1B, the other issue, the other point is Gen AI, and I think you would have expected that question. So, use cases are rising. I spoke with Jamie Dimon, a CEO of JP Morgan. He said, well, within JP Morgan, there are now some 500 use cases. Last night, Mr. Vinod Khosla was interviewed by a Indian founder who said that because of Gen AI, and maybe a little dramatic on his part, he said that most companies can be run with 50% of people. They just don't know how to do it. For a company like you, and you've said that you are also advancing use cases and how this will really fit in. What are the billable use cases right now? How many are there? At what rate is this growing? Just give us a sense.
Yeah, like we said, we started with almost close to 200 plus use cases, and that's growing by the day. And when we are in touch with customers, because when we started the unit, it had to be kind of a show and tell. You had to have use cases to go talk, make the customers see the importance of AI and how it could make things easy for them. But moving from there right now with the unit, or the GBS unit that we talked about has broken even last quarter, which was something that I did touch upon. And that's been only because there has been tangible evidence of what we are doing for our customers through use of Gen AI services. But like you said, there is a lot of research happening on how can you use this to automate. So there is the low-hanging fruit, which is use it for customer support, call center activity, automation of certain basic research activities, repeatable functions. What earlier used to be done through automation can be done through Gen AI. So there is a lot of these things which are the low-hanging fruit, which is getting addressed very quickly. On the supply side, when I say all of this is on the demand side, but on the supply side, we are also seeing, coding using Gen AI. So something that we are tracking very closely is how many of our people are now Gen AI trained, how many of them are using the various tools that are available in the market today to make their coding that much more efficient. We are looking at that coding efficiency improving substantially, and to a certain extent, what earlier used to require 10 people to do in terms of coding, we would now require, let's say, 8 or 9 or 7 kind of people to do the same kind of work. So there is a lot of generative AI being used at the coding end. Today, you must have read there is a company which is in the area of vibe coding, which has got quite a bit of decent funding. That's about how you're able to automate our own internal tasks, which we use to deliver services to a market. So to our customers. So there is a demand side and the supply side. On the supply side, we are looking inwards, working very closely with customers. There is a task force which is going into each of the projects and seeing what part of the work that we do for them.
But Mr. Narayanan, this would be all services, you're not building products for this.
No.
I mean, for example, I'll give you there's a company called Cursor. I heard about it recently, but I'm sure you're aware of it. I think about 18, 20 months old, $10 billion valuation. And it just enables people to code using ChatGPT as the underlying platform. It basically sits between ChatGPT and the coder. Apparently, I was told 80% of software engineers who write code in India use it. But I'm saying, but you will be looking at services, not building products like that.
We will be using companies like Cursor.ai or, Vibe kind of companies which are using those platforms to use and automate our coding experience for our customers, Prashant. That's the way we'll go forward. On top of that, yes, these companies will also become part of our high-tech customer landscape, because they will also want all of it cannot be automated. It's not that you just tell the machine, build me a product called Cursor AI. They are also going to be our customers tomorrow. And they'll also be we'll use our own technologies to help them build this platform. Kind of a thing. So yeah, there is demand in the form of existing enterprises adopting or adapting to AI. There are new emerging companies completely in the field of AI. All of whom we'll be supporting.
Okay, got that. That's of course medium-term perspective and helpful. But Venkatraman, just to come back to the near term, I mean, earlier in this year, you have been guiding for double-digit growth, right? Yeah, double-digit constant currency growth. What are US clients saying right now, particularly in that geography, given the up and down and the uncertainties? I mean, how are spends shaping up, decision-making? How is all that shaping up? And are you on track with that guidance of double-digit constant currency revenue growth and margins, I think, in the band of 20 to 22%?
We are holding on to both those numbers as now. I don't want to get into specifics because we are just going to get into the silent period for Q2. As far as margins are concerned, again, I'd cautioned that there will be slight adjustments for the wage hike that we'll be going through. We have gone through in the current quarter. But other than that, we are holding to those numbers. As far as US as a geography, I would have loved for my colleague and CEO Joseph to give you a first-hand view, because he's there traveling extensively, speaking to customers. Things are slowly opening up, and the entire industry is looking for a better second half. That's how the story right now is, because there is going to be a little bit more of fixity on the way things are moving in the US economy. Obviously, this H-1B thing is a little bit of it just does set some sort of a disturbance, but we should be able to quickly overcome that and get on to talking about business. But that said, we are looking at a very healthy pipeline. It's been building up. We had put in place our new business head and the whole organizational restructure that we did. We are looking at those starting to pay dividends, and we are seeing a good pipeline build for second half and onwards.
Yeah, but what you said is really important to wrap this up. This whole H-1B issue, is it going to lead to delays in deal closures? Because now when a US client is looking to sign on an Indian IT services company, I mean, onshore, offsite, that whole mix, visa costs, like you said, I mean, whether the client will chip in, etc., all those negotiations come in the picture as well. So does it mean as opposed to the expectations of a strong second half, does it actually mean potential delays in closures?
I don't think so, because we are talking about all of these new changes happening from the next filing season, which starts next March. So right now, discussions will be based on people that we have with us today. Most of the companies do certain amount of advance filing, and they have a few set of people already available who can be, put into deployed immediately, or put into the project immediately. Local hiring is something that we have been focusing on. That's something that we'll dip into quickly. So I think in terms of ramping up, the challenges will be almost similar, whether it is on-site or offshore. That's what it'll be.
Okay. All right. Great to have you on, and it's good perspective for us, for your shareholders, and of course the viewers as well. Thank you very much for taking out the time today. Good luck for the rest of the year. Well, that's a view from Happiest Minds. We'll take a quick break. On the other side, we continue with our management conversations. We'll be putting the spotlight on Adani Wilmar and talk about the company's new MOU to set up the National Mustard Model Farm Initiative.
Welcome back. Well, the markets are down mildly, down close to around 20 points or thereabouts. Nothing really to talk about on that front, but a couple of stocks actually are moving up. You have Inox Green, that's bucked the trend, moved to the high point of the day. And you have Max India, that's another stock that's up close to around 8.5%. Maharashtra Seamless, winning an order finally, 250 crores. The street has been a little bit worried. Order book has been dry, but 250 crore order book, order win, street will like that as well. Let's move on then. We have Anshu Malik, the Managing Director and CEO at Adani Wilmar, who joins us on the show. Hi, Mr. Malik. Thanks a lot for joining in. Well, we've got a few queries for you. But before that, let's just highlight the big talking points that we're going to be looking at from this conversation. Synergies from GST rate rationalization. What's the outlook on edible oil pricing as well as on margin? And the MOU to lead National Mustard Mission. What's the benefit on that front? Well, sir, thanks for joining in. Let's talk about GST 2.0. Do you expect volumes to improve in the second half of the year because of GST rationalization, given the much talked about boost for consumption? And in that sort of a backdrop, do you think you'll increase your volume growth guidance that you had given early of around 7 to around 9%? Please go ahead, sir.
I think the reduction in GST has been the most best decision, I think, which has happened from the consumer's point of view, and particularly food, packed food, cosmetics, personal care, everything has now come under the 5%, which is very, very reasonable. This will help not only improve consumption, but it will also help national brands or bigger brands to fight the local competition. That makes it much better for all of us. That is one. Two, overall, the consumption story is very robust now, with very good monsoon and very good kharif production that we estimate, one, and two, lower inflation. All this is going to put lot of money in the hand of the consumers, and consumption story is very robust. I look forward to a very good second half. From one, marriage season is coming up from 15th November, Diwali and Dussehra October, and all this put together till March, at least I see very good consumption story.
Okay, all right. But will you go ahead, sir, and increase your volume growth guidance of 7 to 9%?
I think in edible oil, we have always said that it will be single digit, but it will be a strong single digit. In foods, we have been growing in double digit, and which we will continue to grow. We are sure about it.
And food and FMCG, I think it was around 10% of your total mix, and you're looking to take it up to high double digits, high teens. Could you confirm that, and by when does that happen?
Yes, we are looking at growing this. We have been growing food business at around 20% last 3 years. This first 3-4 months have been a little slow, but I think again it will start picking up from now onwards. Going forward, we see achieving around 9,000-10,000 crore turnover in food business by exit March 27. That is what we have been planning, and that is how we are working on.
Okay. Sir, just coming to this MOU that you have signed for this, the mustard plan. Can you just tell us how this is going to add to your revenue? What is the investment that you'll be making, and over what period of time?
Okay, see, in this collaboration, what we are doing is that we have identifying 3,000 model mustard farm in 9 districts of Rajasthan, Madhya Pradesh and Haryana. These model farms will demonstrate regenerative agriculture practices. We will have climate resilient, climate control monitoring system, satellite-based monitoring system, and soil health. On all of these, we will be working with the farmers. This initiative will bring around 20,000 farmers together, where we will have field demonstrations, we will have field classrooms, and then we will give them digital advisories on how to do best practices for sustainable mustard seed growing. We expect that this practice will help increase 30% almost yield for the small farmers, and that will help in the overall contributing to the national mission on oil and oil seeds that the government of India is doing. This program, we are investing almost 4 crore rupees in 2 years to work closely with the farmers and take this to a bigger scale and showcase this to other farmers that how to grow higher mustard. And I think mustard seed with 40% oil content will contributes on a large basis to the edible oil.
No, sir, just trying to get, so that's the model, we understand that. But we're just trying to also assess what is the revenue implication for you. And if you could also, maybe it's in the medium term, maybe it's not year one, maybe it's not in FY26. What is your FY26, revenue estimates or, your growth guidance? And when will this mustard start contributing, and how much will it contribute from a revenue perspective?
See, it's not that when we participate, we look at increasing our own production. We are looking at overall economy, driving economy through higher production and higher yields. And our mission is that can we grow higher mustard seed as the other nations are growing, and can we contribute in any way? By the way, we are the largest mustard seed processors and crushers in the country, and we have the largest mustard oil brand in the country. So our link with the farmers is that when the farmers grows more, we are able to also absorb them and buy them out and help them get better yield and better money. So the overall objective is that the country should start growing more mustard seed. And let me tell you, in the last 6 years, from 85 lakh tons, it has now increased to 115 lakh tons. We see a great opportunity for country to grow more mustard seed.
Okay, fair point, sir. Beyond mustard, let me just broaden this out. So like you discussed in the opening remarks, there are the GST cuts that have come in. Also, just tell us how the whole year is looking now for your total business overall. What is the volume increase that you are expecting now? What is the outlook on margins given how input prices are moving?
See, on volumes, as I said, the year should end at single digit in edible oil, double digit in higher double digits in food. Overall turnover will cross 65,000 crores for sure. But when we look at margins, the margins are stable. Edible oil prices are stable, which helps us in ensuring the stable margins. And looking forward, if you look from here, the consumption story is very robust, and if that happens, the margins will improve. Overall, the mood of the consumers are much better, and I look forward to higher consumption coming ahead.
Okay, all right. We'll leave it on that note, sir. Thank you very much for joining in. Good to get that perspective from you, and good luck for the coming quarters as well. Thanks for joining in. Well, that's a perspective from AWL coming through. Let's go back to the market and see what the screen is telling us. Very flat and actually recovery. Recovery from what was a near 50-60 point cut when we started trade. So at least we're at the flat line, but it's still choppy, you'd have to say. Nagaraj Sethi is with us for some technical trading ideas. Nagaraj, thanks very much for joining in. Index, any trades today, Nifty or Bank Nifty?
Hi, good morning. Yes, market has been in a downtrend over the last 4-5 sessions, and looking like at the place at the support, the selling momentum seems to be decreasing. Market is nearing a strong support around 24,900 to 25,000 levels, and I'm expecting Nifty to bounce back from the lower levels in the next day or two, and we could see some good amount of bounce back from the lower levels. I think it's an opportunity to accumulate the longer levels for the both Nifty as well as the Bank Nifty.
Okay, all right. Hi, Nagaraj, good to see you in. What about individual stocks? You'll be having a couple of ideas for us.
Yes, I have two stocks. First one is Cochin Shipyard. Chartically, Cochin Shipyard, after forming a bottom reversal around 1600 level, has bounced back gradually, and after a small decline recently moved up very well. The overall chart pattern is looking positive, and the volume breakout as well as the positive indication of RSI is indicating a more positive bias for the stock price in the near term. Currently trading around 1940 levels, one can look to buy at this point of time. The upside target would be around 2050 levels, and one can face a stop loss of 1890. Second one is Oil India. Oil India was in a consolidation phase recently, and today it witnessed a sustainable upside breakout of the consolidation and moved higher. Currently trading around 421.85, one can look to buy at this point of time. 445 is going to be the initial target, and one will face a stop loss at 400.
Okay, all right, Nagaraj, got that. Thank you very much for the updates and for all the trading advice. Back to the screen for a quick check. BEL is an interesting mover. It's finding takers this morning. It's a Nifty winner right now, and it's suddenly sort of shot up from being absolutely flat. Yeah, so there you go. Morning highs on BEL. Hindalco is continuing its good form, and Apollo Hospitals is finding some traction as well. So beyond the usual, we've gotten so used to seeing only FMCG or auto stocks up. Today we have some new names on the screen.
Well, that's right. Even Oil India, another stock, I think, from the broader markets that's seen a bit of a correction. That's moved to the high point of the day. So I think we should get that stock. Even ONGC, I think, from the day's low has seen a bit of an uptake. So some of these stocks, that have some kind of a crude oil play in it, they have moved a little bit high. Even Vedanta has some bit of crude oil in there. So all of these names doing quite well, particularly in the last few minutes. Finiotex Chemicals was the one that we spoke about earlier. That's up close to 15%, waiting for the outcome of the board meeting where they could consider a lot of issues like bonus and the likes. So that's one of the top movers in terms of volume as well. 15% higher, massive volumes on that name. Vinny joins us, sir, to tell about a company that won an order overnight and is doing well today. Newgen Software. Vinny.
Hi, good morning. So yes, Newgen Software is a small cap, mid cap IT company that we're keeping an eye out on. They're growing their international portfolio, and that is why we're seeing the stocks here run up. Now, the company's UK-based wholly owned subsidiary has actually executed a master service agreement with Tata Consultancy Services in Belgium. This deal value is around 4.2 million euros, will provide modernized cloud-based enterprises, records in terms of management of platform as well as end-to-end customer use services in Belgium. Other than that, they've also got a domestic order, a small order of 21 crores approximately from Keshma General Insurance. This is for software license implementation as well as annual support services as well. This is for a period of around 5 years. Do not forget that the stock has actually been underperforming its other peers, and in the last 3 months, it's down almost 19-20%. While Nifty IT, when you look at it, in the last 3 months, it was just down 10%. So yes, the move also comes in because it was underperforming, but a good order win on the global front is keeping the stock abuzz as well.
Okay, all right, got it, Vinny. Thank you very much for that. Quickly hopping across to Vamakshi to take a look at Quality Power. This stock has been surging right from the time the market opened, almost 5-6% higher. Tell us about the news, Vamakshi.
Well, Surbhi, the stock is in focus because Hero Electrical, which is a material subsidiary of the company, has signed a technology co-development agreement with Hyosung T&D India. Now, this is for gas insulated switchgear, which is GIS instrument transformers. Now, this development is quite positive for the company, and that is because, number one, it enables the Meru to diversify into the GIS value chain. In addition to that, it also positions Meru as one of the first companies in India to co-develop GIS instrument transformer tech for the global market. So the technology essentially will be provided by Hyosung, while the manufacturing will be taken care of by Quality Power. Now, other than that, what they're also highlighting is that Meru will be able to leverage Hyosung's expertise in eco-friendly gases and compact equipment design, and they will be able to address new demand segments such as metro, rail, offshore wind, data centers, as well as high voltage urban transmission projects. Now, what they're highlighting is that the development and commercialization of the initial set of transformers will be expected in the next 12 months. Overall, a positive development for Quality Power, and resultantly, the stock is trading higher in the trading session today.
Okay, all right. Thanks a lot for that, Vamakshi. Time to slip into a short break, but on the other side, Manisha Gupta is standing by. She's going to tell us what's going on in the commodity space. You don't want to miss this.
Welcome back. Well, it's time to talk commodities, and we have Manisha in the house to tell us what the latest is. Manisha, yesterday you said the sparkle is moving to platinum. Today morning, what's sparkling?
Copper.
Oh, gosh.
Copper is the new gold is a headline that I've seen in some of those publications today. But absolutely, look at the kind of gains that we've seen in the overnight market. So even as there's a bit of a breather that you're seeing in precious metal prices, it is the base metal prices that you should be looking at right now. So 4% of a gain. We're looking at spot prices trading by 2-month highs, and the 3-month LME, which is traded on a longer term basis, is trading at a 15-month highs right now. So very strong gains coming in for this. So the major reason, of course, has been the Freeport McMoran declaring force majeure from its Grasberg mine in Indonesia. There have been some issues that Indonesian mine have been looking at for some time, but this latest incident that happened on 8th of September seems to be ballooning right now, and there are some hazard concerns also coming in from those mines, and is the reason you're looking at prices gaining up. Now, Grasberg mine is important because it is the second largest source of copper in the world. Also, Grasberg accounts for nearly 2 to 3%, rather 3.2% of global mined copper, and much of that clearly comes in from the Freeport mine there. Now, when you look at the overall output from Freeport as a company, 30% of its copper comes in from Indonesia, and 70% of its gold also comes in from here. Now, Freeport already has cut guidance in sense of production for this year and the next as well. So when it comes to copper, they have cut their sales guidance by 4% and gold by nearly 6% on the lower side. Interestingly, there have been various other reports coming in as well. McKinsey, for one, says that they're looking at 880,000 tons of supply being affected in 2025, not just because of Freeport, but various other mines as well. And I'll quickly come to that. But first on, when you look at Freeport, they have temporarily halted operations at Grasberg with 30% mine operating at this point in time, is what we understand. Well, that is about Freeport. But then apart from that, copper also seems to be looking at a lot of support coming in, especially from China, where the demand has been resilient. Second, it's not just about Freeport, because take a look at suspensions that we've seen in Chile at that El Teniat mine there, which is extended longer than what the street was anticipating. And whenever it starts, would be happening in on a phased manner there. And then you also have the Hudbay Minerals. They also have shut operations at a mill in Peru because of the political protests there. And then it also has been about the Constance mine. We also are looking at concerns coming in from there as well. So it's not just one, but various areas in the world where you're looking at copper supply getting affected. This is a price chart in sense of copper for last many years. And as you can see, in last 5 years, it was only in 2022 that we saw a 14% decline. All other years have seen stronger gains, and 2025 standing with a tall 21% gains in sense of copper at this point in time.
I mean, remember 2021, right out of the COVID year, right? There was this huge excitement around copper, that copper is...
Energy transition and AI and EVs. And,
go berserk. But, as many things in life and markets, it doesn't always play out that way. And very, very useful sort of historical context as well to what's happened there. But 20 points lower on the Nifty, 25,036, 25,035 is where the Nifty is at. So it's very, very quiet. It's been that way from the morning. I'll just quickly outline what's moving with the maximum volume. So Adani Power is the number one pole position, 3.5% price gain. Garden Reach is up 2%. Hindustan Copper is up 4%. Cochin Shipyard is up about 2.5%. And something like a New Gen is up about 5% or so at this stage. By the way, a lot of new stocks into the mix, stuff which was not there in the morning. Inox Green is limit up. Stocks done very well lately. It's up 5% on the day, 206 on this one. On the downside, I think Tata Motors should be there. Yeah, it's the number one volume-led loser, 2.5% cut. Tata Investment Corp, I was talking about this in the morning, went up like a rocket, 5% lower. Aether is down 4.5%. Edelweiss, Astral, and so on and so forth. But volumes much lesser on the downside than they are with stocks which are moving up. So it's a good sign, I guess, in the overall scheme of things. What we'll do is take a quick commercial break here. On the other side is our special segment, is the economy. Lata discusses what to expect from the government's second half borrowing calendar with Arup Rakshit of HDFC Bank and Shailendra Jigan of ICICI Bank. There's an interesting chat coming up just after a quick break.
Welcome to It's the Economy. The government will announce the second half borrowing program, possibly this week itself, today or tomorrow. Here is the math. The government said in the budget it will borrow 14.82 trillion rupees through government securities in the full year. In the first half, the borrowing was 8 trillion rupees. So, obviously, the government will borrow 6.82 trillion rupees in the second half if it is sticking to the deficit. Now, this isn't large. The worry is there is very little appetite for long tenor bonds. In the first half, 35% of the borrowing was done via 30, 40 and 50-year bonds. The market is worried about this high percentage of long bonds in the second half because demand for long bonds in India and world over has been dwindling. To discuss more about bonds, interest rates, I have with me Arup Rakshit of HDFC Bank and Shailendra Jingan of ICICI Bank, both heads of treasury in their banks. Arup, Shailendra, good morning and thank you very much indeed for your time. Arup, first up, is there a fear of the borrowing number being more than 6.82 trillion?
Lata, honestly, good morning. We don't expect it to be actually more than 6.8 trillion. I think they will manage it. They have been very candid about it. The GST cut, even in spite of the GST cut, I don't think the borrowing program is going to go up. If they need later on, they will possibly cut a little bit of government expenditure if it has to come to that. But 6.8 trillion seems to be the number they have in mind, and I don't think they are likely to increase the number.
Yes, Dr. Somanathan has been almost Brahminical about this austerity program. But, you know, it's about a 1.5 trillion giveaway. So that's why I'm wondering. And at a time when tax tax earnings, collections have been much lower than anticipated in the first 5 months. Shailendra, a quick word on the total number. Will there be a fiscal slippage and therefore 7 trillion or something? But more importantly, what is the percentage of long bonds that you're penciling in?
So, Lata, we really don't anticipate, like Arup said, any kind of increase in the borrowing number. There might be a marginal slippage on the fiscal deficit side, but the government has enough buffers. One thing which markets are not really looking at is the fact that the small saving collections this year could be significantly larger. If need be, they can announce higher T-bills if there's a bit of a slippage. But the impact of GST on the current year is not that significant. You're right about income tax, collections being slower, but we know that, there are other buffers in the form of higher RBI dividend. So in that sense, I mean, there is absolutely, very little probability, I would say, of any kind of slippage.
Okay. Fair.
The absolute number. Now, coming to the, you have kind of brought up the point about the long bonds. And why the spreads have been rising and the yields have been rising on the long bond. And just to give a context, I mean, till about 5 years back, the government of India borrowing at the long end used to be about 20%. It went up to 35%. A lot of it happened because the domestic institutional investors, had very large flows. I mean, we know that, the non-par product of insurance companies started picking up. There was a very strong growth in, pension funds, provident fund AUMs, and they were all long end buyers. I think if you look at the last 2 years, there has been a very distinct shift in the profile of financial savings. I mean, for instance, last year we had 64 billion of inflows into equities, from DIIs. And this year, this number has already, by September, it has reached almost same level. And it is not just mutual funds, we know, who are getting these inflows, even let's say in insurance, most of the flows seem to be going to ULIPs. Somewhere the government is also incentivizing, for pension funds. I mean, the minimum allocation for equity used to be 15, it has gone up to 25. So their allocations are increasing. So, there's a shift. And that needs to be recognized. And because of that, I mean, there's a need to shift, the supply from the longer duration bonds to shorter duration bonds. Okay. Just one more point here. I mean, it's not just about, these institutional investors. I mean, if you look at, the bank's investment norms, which came from FY25 onwards, I mean, the HTM has become a real HTM. So, the appetite of banks to buy long end in HTM books is also coming down.
Yes.
So our sense is that, they shift about 4 or 5% from the long end and move it to the shorter end tenors. I mean, that's how, this will look like.
Okay. Arup, very quickly, would you want to add to this disappearance of buyers from the bond market that Shailendra has argued very well? And assuming the government, instead of 35%, brings down the 30-40-year bonds to even, say, 30% or 25%. That's a large fall. Will that really make any difference to the 10-year? Will that make any difference to the actual cost of capital for corporates?
See, actually, what has happened is because of the 35% coming in that bucket, the demand from the banking industry has been a lot lower, which Sandeep did refer to.
Yeah.
And even if at a 10-year is around 26% and 15-year is around 14%. So if you really look at it, our expectation is that some amount of shifting will happen in the 5 to 7-year bucket, which can bring in a little bit of a demand. Today, it's the supply which is far outstripping the demand. So our expectation is it will be more in the 5 to 7-year bucket.
Okay.
See, the 3-year bucket is normally used for the switch, which they have been doing over during this year itself.
Yes.
So yes, 5 to 7 year, you will possibly see a little bit of a cooling of the yields, which really shot up to that 665 level on the 10-year benchmark in August. So that can have a little bit of a...
Okay, so that's all. They can issue more in the 5 and 7 year, you're saying, and less in the 30-40.
Yeah, about a 5 to 7% kind of a shift.
Okay. Well, the other big issue is what the Reserve Bank says. Now, what do you want to hear from the Reserve Bank, Shailendra? Cut or no cut, or what else? The bond market has really lost its verve altogether.
I think in terms of the policy, I mean, when we look at the inflation profile, Lata, for instance, our target for the current year average inflation is 2.4%. I mean, this is significantly lower than the 4% which RBI targets. Agreed, next year inflation will go up, but whichever way you slice or dice the inflation data, you let's say you exclude veggies and look at inflation. The inflation is definitely running below 4%. I mean, the ex-veggie CPI is at 3.7%. Post GST cuts, I mean, the core inflation number also will come down to 3%. So, from the inflation side, there is scope to cut rates. Now, coming to growth, I mean, we think that growth this year will be close to 7%. I mean, there's a negative effect, which is coming from the tariffs, but the GST cuts are coming. And I think there's a quirk in the deflator. So let's say you're getting a nominal GDP number of 8.5%. I mean, the deflators are likely to remain low, so the real GDP will be 7%. But I think what the policymakers need to look at is the continuous fall which has happened in the nominal GDP number. Just to give a context, in FY23, the nominal GDP growth was 14%. It came down to 12 in FY24. 9.7 in FY25, and this year, we expect it to be 8.5%. Now, this kind of nominal GDP growth has huge implications, not just for debt sustainability, but, for things like profit growth. I mean, we know what's happening in equity markets. I mean, the P's are high, but earnings are not there. I mean, so from all perspective, I think, RBI needs to move towards accommodation. Whether they cut in this policy or it's a dovish hold, I mean, I don't want to take a guess on that. But definitely, I think the bias, the talk will be more dovish. And, the policymakers should be looking at the nominal aggregates and the way they have been coming down.
Okay, 2.4 is the average. I thought it was closer to 2.8, but if...
Post GST cut, our average estimate has moved down to 2.4.
Fair enough. I think a poll is in order, and perhaps 2.4 is what I'm going to get. Arup, any thoughts on what you want from the Reserve Bank in addition to what Shailendra said?
No, I think, we are not expecting a rate cut in October for sure. I think it's more likely that they will see what action happens on the growth front post GST cut and then take a call in December on how it moves forward. Also, the tariff, some sanity on the tariff discussions may come through by December. So depending on how they look at the growth coming through or not in this business season, credit growth offtake, that can determine whether there will be a cut in December or not. Whether they go for an accommodative, October to me looks a little difficult to change any stance. I think they will just maintain the same stance, and because there's just too much geopolitical uncertainty which is playing out. So rather than do anything else, they will play it out in that manner. See, currently, if you see, the liquidity has dried up. I mean, it has. Yesterday was actually a deficit.
Okay.
So in that situation, to make announcements differently, they will play it out. And rupee is also not supporting the way it has moved. For them to take any new call at this juncture is my feeling of it.
But you don't expect them to make any pro-liquidity noises. I know yesterday was a deficit, but that's just because, advanced tax and rupee have...
It's a temporary one because the full CRR cut has to yet come back in the system. But if the rupee starts trading the 88, 89.50 up to 89.50 kind of levels, which one expects it can go up, then obviously there may be some need to come into the market, which can then suck out the rupee liquidity also.
Okay. Shailendra, very quickly, do you expect them to say or do anything about liquidity? And, I have another separate question, but very quickly on liquidity.
So I think liquidity, like you rightly said, I think it's more driven by, currently by GST outflows and advanced tax outflows, which were larger this time because, the personal income tax filing date also got delayed. So the system has come in deficit, but the core liquidity is still at a very, huge surplus of 5 trillion. So I think in the near term, there is absolutely no worry on liquidity, or there's nothing which is required to be done on liquidity. So, and this, like Roop said, the CRR cuts are playing out. So I think they'll wait for that. Maybe at some stage later, they might have to, do OMOs. Our sense is that, they could be OMOs or buy-sell swaps, which might come. But that will be a last quarter story.
I was just waiting for the word OMO because I think that's what the bond market will really be exhilarated. I don't see how they can introduce the word I will buy bonds from the market, in this policy itself, but that will be music to everyone's ears. Very quickly, Arup, what I couldn't concentrate on, state borrowings. The second half state borrowings can be very high because they did only, I think, 6 trillion in the first half. You think that can just spoil the play for corporates who are wanting to borrow from the bond market?
Yes, state borrowings are likely to slip, give a little bit of a slippage out there because it can be really high. And we had seen the gap increasing up to almost 100 basis, though now it has come down to about a 40-50 basis. But yes, that is something which can play out in the second half.
And
we do expect states to borrow a little more. And
that can spoil the game for NBFCs and others who are tapping the bond market?
I don't think that will have too much of an impact for the NBFCs and all, but let's see how it plays out. Because, yes, NBFCs have tapped the bond market quite well in this quarter.
Okay.
Effectively, see, the credit growth offtake has still not really picked up in that sense. It's still in the around that 10 to 10.5%, 11%. So if there will be opportunity for even the NBFCs to hit the market and get some. Whether the price may be a little higher than what they would have expected because of this, the state loans also being there. But otherwise, I think liquidity would be there for them to get the bond.
Yep, but who is to say if there is a cut on October 1st, then perhaps borrowing from banks also will become attractive. Let's wait and see.
Unlikely that we will. I don't expect the cut on October 1st.
You're not expecting on October 1st. Arup?
No, I'm not expecting a cut on October 1st.
Okay. Well, we have the Citizens MPC, CNBC-TV18 Citizens MPC meeting tomorrow. Let's see how the vote goes over there. Thank you very much, Arup and Shailendra, for preparing us for the borrowing program and for the policy ahead. We have to wrap up on Bazaar. On that note, Chatbusters coming up.